Good afternoon, everyone, and welcome to today's session. I am super excited that you are here and look forward to sharing some great information with you. I want to just give me one moment. I just want to make sure that all of the technology is working efficiently so we can really get into it. So give me one moment, please. Okay, guys, let's go ahead and get into it. I am going to share my screen. So again, what we are talking about today is building a credit bridge to business success, how to prepare your credit score for funding. This is something that I've had quite a bit of people ask me about how to position their credit so that they can get funding. This is probably one of the most important components of getting funding is making sure that your credit score is on point. So we're going to be talking about all of that today, and I'm excited to share it with you. So, my goal today is to pull back the veil and show you exactly what you need to know about business funding in terms of what different credit and funding options that there are, as well as what the credit score requirements are for each type of program. And if you stay to the end, I am 100% confident you will get the answers that you are looking for. I'm not only going to be talking about the different funding programs and credit score requirements, I'm also going to be talking about how to optimize your credit profile so that it is high all the time and you can get funding whenever you need it. So, what makes this broadcast different? This is actually going to be a weekly broadcast that I'm doing each and every week. I'm thinking it's going to be on Fridays. I originally was thinking Thursday nights, but I'm thinking it's going to be Friday afternoon. So make sure that you stay updated. But what I'm going to be doing is sharing education and training and resources that are all about helping you to establish funding so that you can grow or start your business faster. I'm also going to be sharing resources on how to invest in real estate, how to purchase a home if you are a self-employed business owner, some different programs that are available for that. I'm going to be talking about how to use your IRA as a source that you can use self directed to invest in real estate. We'll be talking about how to form your own bank. So we're going to be sharing some fantastic gems, and I definitely look forward to uh, providing that information and sharing those resources and having some special guests on to talk more about these topics. So, who am I? For those of you that don't know, my name is Jennifer Carol Bolgen. I am actually recently married, so Bolgen is my new last name. I'm actually the founder of Wealth and Legacy Unlimited. And just to give you some perspective on what this company is all about, I actually founded this company uh, because I wanted to extend on what I was previously doing. I was I was previously the owner of a company called Get Your Credit Perfect Now, which was a company that specialized in assisting people with improving their credit. What I was finding is that the majority of the people that I was dealing with were trying to improve their credit because they were trying to get funding in some form or fashion, whether it was purchasing a home, getting personal credit cards, getting business funding, purchasing a car, whatever it was. And so, what I wanted to do, what I was also finding was that a number of my clients were coming back a lot with the same type of credit issues. And while this is, good for my own personal revenue, I was starting to understand that a lot of what was happening was people were not forming better habits, and they were not getting educated on different ways of approaching their money in such a way that they are improving their general financial situations. So the whole concept of Wealth and Legacy Unlimited is to provide training, education, and resources to empower individuals to grow their wealth and build a legacy for themselves and their family. And we do that understanding that business ownership and entrepreneurship is one of the primary fundamentals of, you know, wealth and freedom. So we are offering resources that are going to empower you to build a business, grow that business, and take it from there. So I'm really excited about sharing more of that with you. My background is that I have over 15 years experience in the real estate industry. I was previously a real estate agent, um, a mortgage broker, which I'm currently a licensed mortgage loan originator, and real estate investor. So my background is definitely in that area. And as I mentioned, I am currently a licensed mortgage originator in the state of Georgia. However, I also do commercial lending nationwide. So that is part of what I do right now. Um, I've also helped hundreds of people restore their credit, get funding, and qualify for a mortgage and purchase a home. And, just down to the core, I'm an entrepreneur who has owned several businesses, some of which have been successful and many of which were not, which, is part of that entrepreneurship journey. So, definitely, I have done a lot of things right in business, and I can easily admit that I have done a lot of wrong things in business. The things that I've done wrong have been through a lack of education and mentorship. And so that's part of what I want to offer into the marketplace is education, mentorship where it applies in my knowledge and capacity. And when it doesn't, bring in experts that can guide you along the way. So after doing this for over 15 years, I have learned a few things. I've definitely seen some very smart people with amazing ideas have their businesses fail simply just because they had a lack of funding. I'm not sure if you know, but statistically, most startup businesses fail within the first 2 years, and that is primarily due to a lack of funding. Many entrepreneurs never enter into true business ownership because they don't have the funds that they need to hire help so they can work on the business instead of in the business. And for those of you that may not understand what I mean by that, if you are a self employed person and you are a solopreneur, chances are you are doing everything. You are the marketing department, you're the sales department, you are the research department, you got, you're doing accounting, you're doing all these different areas. And, that is affecting your ability to grow and to scale. And so, definitely having access to funding can make the difference between, a business being stuck and a business growing at a very, very rapid rate. So, some of these lessons that I just shared with you, I personally learned way when the real estate market crashed back in 2008. And I'll just take a moment to just share briefly share my story. As I mentioned, I previously, I'm originally from Los Angeles, California. I currently live in Atlanta, Georgia, but prior to moving here, I was a licensed real estate agent and a mortgage broker. So I'm not sure how familiar you are about the real estate market in Los Angeles in the early 2000s, but at the time, the real estate market was completely on fire. Properties were increasing in value 20, 30, $50,000 within a month. And literally, people were buying up property like it was going out of style, doing refinances, all the good stuff. So it was extremely busy and really good. And, this was really my first initial foray into the area of of entrepreneurship. And, in my mind, I'm like, okay, this is great. Like, I'm, knowledgeable. I'm getting, repeat clients, everything is in flow. This is going to continue. And I had a super rude awakening when the real estate market crashed. It got to a point where lenders had stopped funding real estate deals. I mean, I had clients that had 700 credit scores, um, that just I could not get funding for, and so it was a little bit crazy. But the long story short, my income dried up. Savings started going fast because I had multiple properties and lots of overhead. And as it turned out, I ended up losing everything. So literally went from, a nice five figures a month to, trying to figure out, how I was going to pay the light bill, that type of thing. So it was very humbling experience. And, that is some hard lessons learned as a result of not necessarily properly planning and having some contingency plans in order in terms of, access to capital and funding available to counteract, the ebbs and flows of the market. So, because I have learned the hard way, I want to get you to cheat and do it the easy way so you don't have to go through that. Let's talk about the hard way, though. The hard way is constantly feeling like you're on a hamster wheel to get more business, even if it means working with less than your ideal client. It means having little to no savings so that if an emergency happens or you lose clients in your business, you're devastated financially. The hard way means working 10 to 12 hours per day on your business, doing everything because you can't afford to hire help. The hard way means missing life changing opportunities because you don't have the capital to purchase the inventory or supplies that you may need, or even the coaching that you may need. Um, the hard way is also not making enough money so that you can actually pay yourself. I know a lot of business owners that um, are barely making payroll, or they're, at a position where they can't pay themselves the type of salary that they need to really sustain their own household. So that is definitely the hard way that a lot of business owners find themselves in, just due to a lack of funding. So, my question to you is, do you want to know the easy way that allows you to get rid of your financial worries, alleviate your stress, have the funding you need to grow your business faster so that you can make more money? That's my question. And I can say probably unequivocally that you are all going to say yes, whoever's watching this. The answer more than likely is absolutely yes. So let's get into it. Over the past 5 years, I've been able to help hundreds of clients put their credit in position to get the funding they need. And it didn't take forever, and it was not painful. So, today we are going to talk more about the 3 secrets of making sure that you have the credit score to obtain the funding you need. The secret number 1 is to make sure that you understand the different business funding programs. Secret number 2 is to make sure your score stays as high as possible. Secret number 3 is to get rid of negative, inaccurate accounts in 90 days or less from your credit report. So let's start off with secret number one, making sure you understand the different business funding programs. Now, most people are familiar with going to their neighborhood bank, their Wells Fargo, their Bank of America, and talking to their business account manager and trying to apply for, funding directly through their bank. And if you've ever tried this route, then you know that most banks are very tight when it comes to their requirements in terms of giving business funding. It's very difficult for a startup business or even an established small business to get a traditional loan from a bank, from a traditional bank. So unless you are a very well established, extremely profitable company, and you have assets, more than likely you're going to have some challenges going through that traditional uh, means. So there are some a variety of different options that we can look into, and we're going to talk about that. So the first one is something called credit card stacking. The second option is term loans. The third option is SBA loans. The fourth option is invoice factoring. The fifth option is working capital loans. The sixth, merchant cash advances. The seventh, equipment financing. And number 8 is startup funding. So let's go ahead and get into it. So, what is credit card stacking? Credit card stacking involves obtaining multiple business credit cards to access funding. There's a lot of misinformation out there when it comes to getting business credit cards. The main factor that applies when getting business credit cards is your own personal credit. You can build business credit and build it in such a way that you can obtain business credit cards that are not attached to your EIN. However, it is not necessary as something that you need to do in order to obtain a business credit card. The most important factor is your personal credit score, which the minimum I would say would be at least a 680 credit score. However, with the market being what it is, and a lot of lending in general tightening up, I would definitely recommend you be at a 720 or higher for this type of program. But basically, what credit card stacking is applying for business credit cards using, under your business name, but using your personal social security number. So you are a personal guarantor uh, of your accounts. However, it will not show up on your personal credit. So as long as you maintain good payment history, you do not default on that credit card account, you will not see that particular account reported on your personal credit. So that's a major advantage. And the other main advantage of this type of program is that it is pretty easy to get. So usually you can start getting these type of approvals within 24 to 48 hours. The main thing that you want to know, or that you need to keep in mind, is that you want to make sure that you are applying with companies that you can actually get approved from, because once you start getting a certain amount of inquiries on your credit report, then you will just start getting denied just based on the mere volume of inquiries. So just something to keep in mind, and we can kind of talk more about that later. Another option that you have for funding is something called term loans. Term loans are from banks and online lenders, and they typically require higher credit scores. A term loan is just what it sounds like. You are getting a loan for a certain term that is determined by the bank. They are generally going to look for credit scores of at least 700 or above. It's generally desirable. but some lenders will consider credit scores in the range of 650 to 700. So there is some flexibility in the credit scoring on a term loan. The thing to know is that you will need financials from your business. So that means tax returns, bank statements, P&L, that type of thing. So this type of program is not for startup businesses. This is for a business that has been established already. Another type of loan program that is fantastic is SBA. SBA loans are government guaranteed loans that are typically offered through banks. The SBA itself doesn't set a minimum credit score requirement, but most lenders prefer borrowers with credit scores of 680 or higher for SBA loans. So the thing to notate here is that SBA does not set a minimum credit score, which is good. That works on your behalf. However, as I just stated, most of the banks that you would apply through will set their own internal minimum requirements. So, of course, the higher your credit score, the better your options are, but that's something to keep in mind. In terms of SBA, they will be looking for financials. SBA does have a startup funding program that you can obtain, which is based on if you have collateral, personal real estate holdings, that type of thing. You can also get some type of startup funding. But SBA has a variety of different options that can be very favorable for businesses, and their rates are generally pretty good as well. The next option is invoice factoring. Invoice factoring is a form of financing where a lender buys your outstanding invoices at a discount. So, with this, your credit score requirements may not be as strict for invoice factoring. Some lenders will go all the way down to the 500s. So, just know for invoice factoring, they are basically buying your outstanding invoices. So, let's just say um, you're a company and you have a client that has agreed to pay you a certain amount over the course of a year, and you're in a position where you need funding for your business now. These invoice factoring companies will buy those pending invoices from you. Let's just say they're going to pay you 100,000. They may buy it, at a discount. Let's just say 70 or 60,000, and give you that net amount and collect from your client on the back end. So that's basically how the factoring process works. Working capital loans. Working capital loans are meant to cover short-term operational expenses. For these loans, a credit score of around 640 or higher may be considered by certain lenders. So again, with working capital, it's just like what it sounds. Anything that you need to keep your business operational would be considered a working capital loan. Next, we have merchant cash advances. Merchant cash advances provide funding based on future credit card sales. Credit score requirements can be more flexible, and some lenders may accept scores in the 500 to 600 range. So, similar to what we discussed earlier regarding the invoicing, merchant cash advances work similarly in that they are advancing you an average of they're advancing you based on the average of the credit card sales that you have had in your business over time. So if they can look at your past 12 months worth of credit card sales and say, okay, this person averages $50,000 a month in credit card sales, they can advance you a certain percentage of that based on your averages. So that's basically how that works. And then we have startup funding. Startup funding is typically more challenging to secure, and lenders may look at other factors beyond just the credit score. However, for traditional startup loans, a credit score of at least 680 or higher may be required. So again, what they're going to be looking at if you're trying to get startup funding is your credit as well as your current income source. I've had plenty of clients come to me that have no source of income and marginal credit, and they're trying to get startup funding. That is not going to happen because, again, if someone's giving you money, they want to make sure that you can pay them back. If you are a startup and you don't have a history of revenue from your business, then the only thing they have to go on is your personal credit score and your current income. So that is pretty much how startup funding works. You want to make sure that if you are in that position, that you either have a current source of income or you have a cosigner that can go on the deal with you to assist you with qualifying there. Now let's get into secret number 2, making sure that your credit score stays as high as possible. Now, I'm sure you've probably seen a table like this. This is breaking down uh, the, the various credit scores, the FICO scores. And let's go through it. So the minimum credit score that is available is 300. Um, 300 to 579 is considered a poor credit score. And if you fall into this category, then you definitely have some work to do to get yourself ready for any type of funding. Um, as you will see, that number 16% of Americans have credit scores that fall within that category. Um, and if yours does, then you definitely want to make sure that you are getting some credit restoration done so that you can get yourself back on track in the way that you need to. The next tier is 580 to 669, and this is considered fair credit. And by fair, that means it's okay, but not really good. Um, at this level, you're likely to still receive denials many times on applications for credit. Um, Anybody in this range has some type of credit issue, something either like a late payment or a collection account or just high balances on their credit card, something of that sort. So your credit score is okay. It's not terrible, but it definitely is outside of the category that you want to be in. And 17% of Americans have credit in that range. Now, let's talk about the next tier, which is the good tier. The good tier is really between, they have down here 670. I'm going to say really closer to 680 to 739 would be considered good. This is where you start getting approvals with better terms and much smoother transactions. This is a good place to be. You want to be good or better. 21% of Americans have credit within this range. The next tier is very good. This is people from 740 to 799. And this is an optimal range that you want to be in. Um, Definitely one of some of the factors that influence whether you get funding or not is beyond just your credit score, because I've definitely seen plenty of people that have excellent credit scores, they're 780 and above, but they have a very limited credit history or a very what we would call a thin credit file. So while your credit score is very important, you also want to make sure that you have what's called credit depth, which is showing that you have a history of making on-time payments and handling your credit responsibly. But in terms of one of the factors, definitely credit score is major. We're going to talk a little bit more about credit depth in a little while. But as you can see, 25% of Americans have credit that falls within this range. So this is an optimum range that you should be looking to get into. And the best tier, which is, the ideal, is exceptional. That is when you have credit within the 800 to the 850 range. 21% of Americans have credit within this range. And this is when you start getting easy 0%, 0% interest, car approvals, credit card approvals, anything that you can imagine. You can get the absolute best terms available when you have credit scores in this range. So definitely you want to get into the very good and the exceptional range. So let's talk about how to keep your credit score high. This is kind of like a funny topic because I know some people are like, this is kind of obvious, but I actually have seen and talked to many people that really don't quite understand how major some of these factors are. So I don't want to make light of it and assume that because I have definitely learned over time that a lot of people really don't know. One of the biggest factors um, that impacts your credit is paying your bills on time. So you want to make sure that you're paying your loans, your credit cards, whatever type of credit that you have, that you are paying it on time every time. If I had a penny for every time that I have spoken with a client who, had a financial hiccup and wasn't able to make their credit card payment on a specific, on time, and just said, hey, I've had a they're thinking they're good because they have really good credit. They've had it for a long time, and then, something happens and they skip that one payment. They don't think it's going to impact their credit as much as it actually does. I've seen people drop like 70, 80 points with just one late payment, and it can happen just like that. And so it's really, really important that you make sure that you pay your bills on time. If for some reason that you cannot make your payment on time, one of the things that I recommend is contacting the creditor directly. A lot of creditors will work with you and uh, revise the terms of repayment. And if they're not able to do something like that, then you want to make sure that you at least make your payment before the full 30 days have passed. You do have, even when you're, let's just say your payment is due on the second of the month, your payment is not considered officially 30 days late until 30 days later, and it will not reflect on your credit report until then. So even though it may be late and your credit company may charge you a late fee, it's not going to actually impact your credit until it's actually been over 30 days. So that's something also to keep in mind there. One way to make sure your payments are on time is to set up your automatic payments or set up electronic payment reminders. Um, and if you've missed payments, make sure that you get current on those payments and stay current. That's really, really important, and it can be a major factor when it comes time to getting funding for your business. Next tip on how to keep your credit score high is to don't close your credit account. Don't get close to your credit limits. Excuse me. The credit scoring models look at how close you are to being maxed out. So try to keep your balances low compared to your total credit limit. You should limit your use of credit to no more than 30% of your total credit limit. If you do decide to go over that 30%, then make sure that you pay off the balance each month to keep the best credit scores. Now, this is something that a lot of people don't realize, and it can really be the main factor that is keeping your credit score low. Um, You can have perfect payment history. However, if you are maxed out on your credit, then your credit score will stay low. And this is one of this is actually the second biggest factor that impacts your credit score is utilization. How do you actually use your credit? So if you, for instance, you have a credit card and you do have an expense that comes up and you need to use, more than 30%, that's totally fine. You just want to make sure that by the time you make your monthly payment, you get it back down to 30% or less. The lower that you get in terms of the percentage, the higher your boost to the score. So 10%, 5% of the available limit is ideal and will get you a very nice boost to your score. So that's something to keep in mind there. Also, do not close your credit card accounts. This is something that surprises a lot of people. I talk to plenty of clients who work really diligently on paying off their credit cards, getting out of debt, and they close those accounts once they've done that. And what they are surprised to find is that once they close those accounts, their credit scores can usually take a dip of about 40 to 50 points. And that happens because the credit scoring model is wacky. Just no way else to say it. It is being responsible, paying off your debt, and you think you're doing the right thing by closing your credit card account, so you're not putting yourself in further debt. However, the credit scoring model actually penalizes you for closing accounts. It doesn't matter if the creditor closes it or you close it. Whenever an account closes, your score will drop. So something to keep in mind is that even though the score will drop for generally the first 60 to 90 days, sometime after that, it will rebound. It will go back up. So just make sure that if you do decide to close your account, that you're not looking to get funding within 90 days of that time period. If you can avoid that, I would definitely recommend avoiding closing your credit card accounts, as it can definitely cause your score to dip significantly. One of the other factors to keeping a high credit score is having a long credit history. A long credit history will definitely help your score. Credit scores are based on experience over time. The more experience your credit report shows with you paying your loans on time, the more information there is to determine whether you're a good credit recipient. So, again, this particular factor is one of the most important factors when it comes to your credit score and how it's calculated. So, definitely having accounts for a long time can help you significantly with keeping your score high. In line with that, you can also help yourself by getting added as an authorized user on a credit card. This can help you to get high limit approvals, and it can also help you to increase the amount of credit that you can actually qualify for. So, for example, let's just say that you have a 650 credit score, your payments have been pretty decent, you're looking to increase your credit score even further. You have a family member who has exceptional credit. Let's just say it's your mom. Your mom has exceptional credit. She's been paying this credit card for over 20 years. She always pays it on time, never, uses more than 30% of the available limit on the card, and she goes ahead and adds you on as an authorized user on that card. When she does that, you're actually going to get the benefit of that 20 years worth of history added to your credit profile. So, in doing so, it's going to give you a significant boost to your credit, mainly because one of the biggest factors in your credit scoring is how long that you have had credit, combined with, responsible credit utilization, which it sounds like in this scenario she would have. She's been paying the payments on time for the past 20 years. So, authorized users are definitely a shortcut to help you to boost your credit score super fast. And it also can help you with qualifying for higher limit approvals. And how that works is that creditors tend to give approvals that are similar to the ones that you currently have on your credit report. So let's just say on your own, your highest credit limit is $1,000, but you get added on as an authorized user to an account that has a $20,000 limit. You are going to find yourself getting a much higher credit approval when you go to apply next time, based on the average between your lowest, not your lowest, but your accounts that you have personally, and then the authorized user that you've added on. So definitely, this is something that can help to boost your score and increase the amount of credit that you can actually obtain very quickly. Um, my company, we actually do offer authorized user trade lines. Um, Trade lines are just another word for saying authorized user credit card accounts. But we have relationships with hundreds of individuals who have excellent credit. They have credit cards uh, that they have used over many years, excellent payment history, low utilization, and they have agreed to allow individuals within our network to piggyback on their good credit history and add them on as authorized users. So if that's something that you are interested in, definitely make sure that you reach out to me, because that is something we can help with. The other tip that I have to keep your credit score high is to only apply for the credit that you need. Credit scoring formulas look at your recent credit activity as a signal of your need for credit. So if you apply for a lot of credit over a short period of time, it may appear to lenders that your economic circumstances have changed negatively. So simply put, if you start, applying for a bunch of credit on a Monday, you've got like 6, 7 credit card inquiries. Regardless of what your credit score is, you're going to start getting denied, just because, creditors don't like to give money to people who they feel urgently need money. Um, they like to give money, but they don't like to give it to you if they feel like you urgently need it. So, just something to keep in mind. Make sure that you are very careful about your inquiries and over applying for credit in a short period of time. Another way to keep your credit score high, make sure that you fact check your credit reports. If you spot suspected errors, make sure that you dispute them. If you have old credit card accounts that you're not using, make sure you keep an eye on them to make sure that there's no identity thief that is using them. This happens a lot with people who have cards that they haven't used in years and who may not be actively monitoring their credit. So I 100% recommend that you make sure that you sign up for credit monitoring so that you can stay aware of what exactly is going on your credit at all times. And then another bonus tip is, if you are new to credit, meaning that you have very little or no credit history, you should consider getting products that are designed to help you establish and build credit. So, some of those products are things such as secured credit cards, credit builder loans, companies that report your rental history to your credit report. They're tailored to helping consumers that are new to credit to establish and build their credit. So, these are some ways that you can start to build your credit profile. And the thing to know is that when you are looking at obtaining funding, if you're looking at something along the lines of credit card stacking, they're going to want to see that you have at least 2 years worth of your own personal credit accounts. If you are uh, looking to get something like term loans or any of these other types of loans that I mentioned, those are more based off of the financials of your business. So that will factor in a lot more than the depth of your credit history. That your credit history is very important when it comes to obtaining business credit cards, that type of thing, because the main factor that they're looking at is your own personal credit score. Regardless of whether you add an authorized user or not, let's just say you have, I see this quite a lot. People will have some credit issues. They go through a credit restoration process. They get all these different items removed from their account, and now they have like one account left on their credit. They go and apply for a credit builder loan, they get a secured credit card, and then 4 months later, they want to see if they can get funding. With that type of situation, it does not work because, again, even if you add trade lines onto your credit profile, the creditor wants to see that you have at least 2 years of your own personal credit history on your profile. Now, this didn't used to be that way. A few years ago, they were a lot more lenient on that, but most lenders have pretty much tightened up their guidelines in that regard. So you will need at least 2 years worth of history. What I also recommend is that you look at getting at least 3 revolving accounts, revolving meaning like credit card accounts, um, and at least 1 installment account. So installment meaning like a car loan, a student loan, anything like that would be considered um, an installment account. So let's talk about secret number 3. Get rid of negative, inaccurate accounts in 90 days or less. So let's talk about what the Fair Credit Reporting Act is. What is the Fair Credit Reporting Act anyway? The Fair Credit Reporting Act is the United States federal law that regulates the collection, dissemination, and use of consumer information, including consumer credit information. This is very wordy, and it's a way just to say that the Fair Credit Reporting Act really is designed to protect you as a consumer against false or erroneous information appearing on your credit report. You are legally protected by the Fair Credit Reporting Act to make sure that the information reported is 100% accurate. And that's why it's important to know your rights when it comes to your credit report. Many people don't realize how much legal rights that you actually have in terms of how the information is reported, and they just accept what the credit bureaus report on their credit and think that they have no recourse, but nothing could be further from the truth. So some of your rights that you need to be aware of is number 1, all information listed on your credit report must be 100% accurate. If there is any type of inaccuracy and the creditor cannot verify that information with the credit bureaus, then it has to be deleted. Another important right is that anything on your credit report can be disputed. And this is something that a lot of the credit reporting agencies don't really want you to know because, again, they are a for-profit business who makes money. They make more money selling the information of people with bad credit than they do for the people that have excellent credit. So they're not incentivized at all to help you or to educate you on your consumer rights. But in essence, anything on your credit report can be disputed. And if the creditor does not verify that information within 30 days or less, then the credit reporting agency is required to delete that item from your credit report. If they do not respond to your dispute within exactly 30 days or less, then they can be liable for up to $1,000 per item per bureau for the inaccurate reporting. Now, this is something that most people do not know, and this is something that you can actually take these creditors to court and you will win as long as you have documentation to support the timelines and that they did not follow and comply with the federally required guidelines under the Fair Credit Reporting Act. You can get better and faster results by disputing directly with the creditor. This is actually something that a lot of people are unaware of. Most people are familiar with contacting the credit bureaus, sending letters to the credit bureaus, and disputing that way. However, you can actually get much faster and better results by disputing directly with the creditor themselves. And that is something that we teach and train our clients and work with our clients on to help them to get their credit back on track as soon as possible. Now, it's important that you get your credit in order before you need it so there are no delays in your funding. This is one of the biggest things that I see time and time again. People are not monitoring their credit, and then they wait until they are ready to pull the trigger on funding that they actually need and require for their business, and they are not ready because they did not monitor what was going on. So definitely make sure that you are staying abreast of what is going on with your credit. So I hope that you enjoyed the time that we spent together on this session. Obviously, I can't cover everything that you may want to know about funding and, the credit required to obtain funding. However, but what I do know is that I have provided you with an outline of what the different loan programs are, a little bit about what their guidelines are, what type of documentation requirements they require, as well as the credit scores that they are looking for. So you are actually now in a good position to understand what program would probably be most suited for you and start moving in that direction in terms of monitoring your credit, making sure that you're staying abreast of that so that you're fully prepared when you're ready to pull the trigger. Now, this is the first of many sessions that I will be doing. I'm actually going to be hosting a live webinar every single week, and the date and time is still to be determined. I was originally saying Thursday evenings, but I'm thinking it will be on Friday afternoon. So make sure you stay tuned for my announcement on what date and time that will be. But if you do need any assistance with looking at your credit, creating a customized plan of action to get yourself ready for funding, I'm inviting you for a limited time to schedule a free consultation with me. And this is something that I normally do not do. I actually charge anywhere between $97 and $147 for these sessions. However, for a limited time, I'm offering it for free. So I say take advantage of this while it is still available, because more than likely I'll be taking this link down in a little while. So make sure you take advantage while you can. You can go to calendly.com/the First Lady of Funding /biz funding. And I'll go ahead and post that link underneath this video. I also want to invite you to join our community, the Credit and Capital Club. In this community, we are going to be sharing exclusive content, giveaways, and you will be able to join a community of like-minded business owners and would-be business owners who are looking to level up and increase their wealth and legacy in their life. So make sure that you tell a friend to be in this community. You can get access to it by going to thecreditandcapitalclub.com. And definitely, we are going to be dropping some really great gems. I'm going to have some special guests in. We're going to be doing some in-depth training. So it's definitely some stuff that you don't want to miss if you're looking to increase your net worth, get your credit in, the best place possible, and position yourself for funding, whether that be business funding or personal funding, purchasing a car, purchasing a home, investing in real estate, whatever you are looking to do, we are going to be covering it in the Credit and Capital Club. So again, I really appreciate the time together. I look forward to seeing you on next week. And again, make sure you share this video with your friends and family. Make sure to like, subscribe, comment, ask any questions that you may have. And I look forward to speaking with you very soon. Take care. Bye-bye.